You still have the American public who has yet to really take your advice, Robert. They're beginning to. They're waking up. But this is simultaneously happening when the COMEX market is experiencing the largest deliveries that they've ever had in the history of the market. In fact, the May delivery contract for COMEX, where the prices are set globally, delivered the largest amount of gold and silver in the history of the COMEX ever. The biggest money up here, they're standing for delivery. They're the ones pushing the price higher. So what that means is there's more physical metal available on the street than the dealers have the ability to sell.
In the current financial landscape, silver is quickly becoming the most mispriced and misunderstood asset in the global economy. Despite hitting the $38 mark in recent days, most retail investors remain on the sidelines. This is happening even as demand from central banks, sovereign wealth funds, and private institutions quietly drains the available physical supply. Gold continues to dominate headlines, with prices surging past $3,350, a clear reflection of global de-dollarization, geopolitical uncertainty, and relentless central bank buying. But it's silver that presents the most asymmetric opportunity. Unlike gold, silver is not just a monetary metal, it's also a strategic industrial resource. And with global supply chains tightening, mine production flatlining, and COMEX inventories collapsing, silver's breakout is no longer a matter of if, but when. In today's video, we bring you clips from a recent discussion between Andy Schectman, president of Miles Franklin Precious Metals and a prominent voice in the bullion market, and Robert Kiyosaki, author of Rich Dad, Poor Dad, whose long-standing warning about fiat currency debasement and the need for hard assets is aging remarkably well. In this interview, they unpack the structural breakdown of the paper-silver market, discuss why current low premiums are an anomaly, and explain how institutional money is already standing for delivery, bypassing futures games entirely. Stay with us as we break down exactly how the paper-silver facade is crumbling, and what it means for your portfolio. If you're watching this, you're already ahead of the curve. Now is the time to get informed, get positioned, and stay prepared. Don't forget to like, subscribe, and share this video with someone who's still sleeping on silver. Let's dive in.
You obviously like it when people buy from you. But what happens when somebody comes in to sell their silver or gold to you?
So most of my career, which is 35 years now, almost 36 years, Robert, whatever product you would be selling, you would receive a premium, a excess premium above the spot price, above the melt value. Whatever the product was, some products would have a higher premium than others, but there was always a premium. We can use Silver Eagles as an example, and I can show you what you're really getting at here using Silver Eagles. So let's just pretend that you called me November 2019 and said, I'd like to buy a mint box of Silver Eagles, 500, 1 ounce, brand new United States Silver Eagles. Sure. You say, Andy, what will you sell it to me for? And if I should need to sell it back, what will you buy it for? I would have said to you something like this. Now, this would have been the same answer I would have given you for pretty darn well near 30 plus years. And I would have said, sure, Robert, I will sell it to you for $3.29 over the price of silver. I'll buy it back from you for $2.79 over the price of silver. That spread, $2.79 to $3.29, 60 cents or so, would have been our commission per coin. So $300 on a mint box. That would have been for almost my entire career. That would have been standard. Now you say, okay, I'll do that. In fact, I want to get $100,000 worth. Sure. This is November 2019. You call me back 6 months later, March, April, May 2020, the pandemic had hit. Andy, the pandemic really affected my business. I need to sell those mint boxes. You told me that you would pay me $2.79 over. Is that still good? I'd say, no, it's not, but how about $11 over? Because the demand was so high for the price of silver, and for silver American Eagles, that in 6 months, the premium went from $2.79 over bid price to over $11 over the price of silver. bid price, where it stood for most of the last, or 2020, 2021, 2022, 2023. And then things changed. They changed in a very substantive way. And that's going to get us to where we are now. So at least in terms of looking at where we were and where we were before that, you always would receive a premium above spot, but a small one. Then came the pandemic. The premiums went much higher. But let's discuss, before I get to where we are today, how those premiums are derived. Now, there's about 5 or 6 massive primary distributors. These are the distributors that work directly with the mints and the refineries globally. These are the companies that some of them are publicly traded. They spend billions with a B of dollars buying and selling precious metals every year from the global mints: South Africa, United Kingdom, Australia, Canada, and the United States, and Austria, the 6 primary mints. And their job is to provide liquidity to the market, to be a market maker. So let's go back to the pandemic. These primary distributors who have agreements with, let's say, the United States Mint, they take everything the mint will give them because there's so much demand. The mint says, we're out of product. That's it, no more product. These primary distributors then become the market makers moving forward. They are the ones that set the premiums either to the upside or to the downside. There's so much demand in 2020 and 2021 that they say, we'll pay anyone that wants to send us their Silver Eagles $11 over the price of silver, but we're selling them at 12 or 13 or 14 over. Now that spread, which was much bigger than normal, was big because you can't hedge the spread or the premium. You can only hedge the metal content. So anyways, first and foremost, your guy in Arizona really is not the one who sets the premium. It's whoever he's going to sell it to. The big primary distributors. They're the ones who set the premium. What's interesting about right now, maybe the most interesting thing about the environment we find ourselves in right now, and why the premiums are so low, is that really starting in 2024, we had the rise of NVIDIA, the accentuation of the Mag 7, the huge demand for cryptocurrencies, Bitcoin. You've talked about that for a long time. And so the American public did this 180 during the pandemic and the banking crisis, from risk off to risk on. And we saw a lot of selling and non-participation in the metals market. So the premiums went down. But here's where it gets really interesting. Where we are right now is a very unique situation, because you still have the American public who has yet to really take your advice, Robert. They're beginning to. They're waking up. But this is simultaneously happening when the COMEX market is experiencing the largest deliveries that they've ever had in the history of the market. In fact, the May delivery contract for COMEX, where the prices are set globally, delivered the largest amount of gold and silver in the history of the COMEX ever. The biggest money up here, they're standing for delivery. They're the ones pushing the price higher. The public hasn't. The public has a very tiny, if any, allocation to precious metals. In fact, Rick Rule says 0.5% across the entire United States, from Joe and Jane six-pack to the Harvard Endowment Fund, in terms of allocation to metals. So what that means is there's more physical metal available on the street than the dealers have the ability to sell. And so as more people come in, the bid prices are getting lower and lower and lower. At the same time, the people at the top are draining the world's exchanges. It's just a matter of time. So anyways, all I'm trying to simply say is this. Until 2020, premiums were almost consistent forever. You pay a few percent over spot when you buy, you get a couple percent less, but still over the price of spot when you sell. Since 2020, everything's gone crazy, whether it be premiums that are higher than anything I've ever seen in my career, to where we are right now. And in defense of this gentleman, I will say industry-wide, the premiums are lower than I've ever seen, ever in my career. And it's not us. It's the people one step above us, the primary distributors, that are the market makers. That's really as honest of an answer as I can give you, is that when I take in $1 million worth of gold and silver, if I can sell it to my clients, great. But if I'm a coin shop in Arizona, I may not have that ability and I may not have that liquidity. So I have to turn around and sell it to a company like me or a company above me, the primary distributor, and the bid prices are going to be lower because there's so much excess supply built up because the public has been chasing profit instead of realizing what the biggest money in the world is doing, standing for physical delivery. And it's a cycle, and we're at the bottom end of the cycle now. I would expect to see premiums move much higher industry-wide as there's more awakening in the American public who finally start to say, Robert Kiyosaki was right a long time ago. I should have been buying silver and gold. And when that happens, just like that, the premiums will flip.
One of the most important takeaways from Andy Schectman's discussion with Kiyosaki is this: the relationship between spot price, premiums, and physical silver availability is fundamentally broken. For most of Andy's 36-year career, premiums on U.S. Silver Eagles hovered around $2.79 to $3.29 over spot. That stable range reflected normal market liquidity and balanced supply-demand. But in 2020, everything changed. The COVID-19 pandemic triggered a massive surge in physical demand, depleting mint supplies and driving premiums as high as $11 to $14 above spot. That wasn't a retail phenomenon. It was driven by primary distributors, the global liquidity providers who buy directly from mints like those in the US, Canada, Austria, and South Africa. Here's where it gets even more interesting. Despite falling premiums in 2024 due to speculative flows into AI stocks, crypto, and the Magnificent Seven tech names, the physical silver market is tightening again, not on the retail end, but at the institutional core. In May, the COMEX recorded the largest gold and silver deliveries in its history. These aren't paper trades. These are high net worth and institutional entities, standing for actual metal, draining warehouse inventories, and pushing the system toward a delivery crisis. Meanwhile, most American investors, as Rick Rule noted, have less than 0.5% of their assets in precious metals, leaving a colossal demand surge just over the horizon. The mismatch between visible supply and actual ownership is setting up what could be the biggest silver price shock in modern history. The current low premiums? Don't be fooled. As Schectman warns, this is merely the bottom of the cycle. Once sentiment turns and the public starts to buy, those premiums will spike violently, not just because of demand, but because the available product simply won't exist. As the COMEX cracks and the spot price decouples from real-world delivery premiums, we are watching the slow-motion collapse of the paper-silver pricing mechanism. This system has kept silver artificially cheap for decades. Next, we delve deeper into this. In another exclusive interview, Andy Schectman reveals how central banks are bypassing COMEX entirely, how upstream distributors manipulate premiums, and why the real silver story has only just begun.
The silver market and to an equal degree, the platinum market, to me, are under great stress at the futures level. And it seems to me prices are disconnecting on the futures from the real physical prices. You have a situation where it seems to me that traders across the globe, whether it be in London or in the United States now, are rushing to secure metal to avoid the risk of physical shortages. And physical shortages at that level are very prevalent right now. We can start with the London Metals Exchange. The London Metals Exchange is a 140-year-old exchange. It's the oldest in the world. And according to an article that just came out by a TD Bank analyst, it's the lowest free float ever. He argued that the outflow of silver out of the LBMA because of the tariff arbitrage, which I don't really agree with, because I think that was the cover to reshore all the metals. I think it's much deeper than that. I think someone got into Trump's ear and said, listen, man, if you don't do this, if we don't bring this shit back, it's a big, big, big problem. The rest of the world is doing it, and I think he understood that. But what he came out and said is because of that, the inventories of freely available silver, we call that the float, is the lowest level in recorded history since they've ever been keeping records, ever. And so I think the number was 155 million ounces. That's less than a day's worth of trading volume for spot silver in London. And this is a short squeeze in what arguably is the world's most important silver trading hub. At the same time, as a result of that, you have a dramatic spike in the cost of the 1 month lease rate or borrowing silver. It's gotten as high as 8%. This is a level that you never see. So you have to pay 8% to borrow silver to cover a short position, perhaps. And this illusion of liquidity from the silver markets, Jared, in my mind, only rebalances, and I think in this analyst's mind as well, through some sort of a squeeze where the physical price has to go much higher. It's already up 33% this year, outpacing gold basically, but it has to go higher. Now, the LBMA, just to underscore that as an aside, is a T+1 market. I think we talked about this before. That's T plus 1 day. T is trade day plus 1 day to settle. On the third day, your metal should be moving. If you own a multinational gold and silver jewelry company and you need these bars to fabricate your jewelry to sell all around the world, and you have these contracts, you stand for delivery, you need it, you're going to start making jewelry. Well, sorry, man, we know it's T+1, but the Bank of England is telling us it's a shortage of manpower and trucks, that they don't have enough, so it's as long as 8 weeks you're going to have to wait. What that really means is they're caught with their pants down. Now, that 155 million ounce float, David Jensen is someone you would love to have on your show. I'm going to try to get him on mine. He's an analyst for the LBMA, and he's phenomenal, and he has a Substack. Okay, so he says that this free float is 155 million ounces, but they're trading that entire amount every single day. In fact, his numbers were higher, 180 or 90 million ounces every single day, which would be the entire float every day. And okay, that's bad enough. But he also goes on to say that the numbers that they post are the final settlement numbers. They are not the daily trading numbers, which they trade 10 times as much, 10 times more than what they're showing. So they're trading as much as 1.9 billion ounces a day, per day, every day, with only 155 million ounces behind it. What could possibly go wrong when you're trading 3.5 times annual global mine supply and 12 times the available float? Well, how about T plus 8 weeks? That's a problem. And then you take a look at the COMEX, and the commercials 2 days ago had about 80,000 contracts net short. That's over 400 million ounces. And they built this massive short position right around 37.50. So silver was up to 39. They were hemorrhaging. Doesn't surprise me that they're trying to bring it down right now. It's at 37. They're getting closer to that point where this short position is at. They've knocked it down a bit. But they're trapped, and the breakout, the setup is explosive, and the ability to hold the price down is insane. If you're selling short over 400 million ounces, think about that. That's 3 times the float on the LBMA and many times the float on COMEX. This is an existential threat. So not only has silver hit its highest mark since September 2011, the banks just set a new record for their largest short position ever. At the same time, the exchange for physical, this is when you would exchange a contract for physical or a physical for contract without going through the settlement process on COMEX, it surged almost 250% in the last couple of days, meaning if you want to do this, you're going to pay through the nose because the traders know that these short positions are very dangerous, could very well be trapped. So this increase signals serious stress in the silver market. That's the truth. Now, look, what it means, traders are scrambling to find physical silver, which is in short supply at those levels.
Yep.
And this often reflects not only tight physical market, but trust in the system is finally breaking. They don't trust the system. No, we don't want your paper. We don't want to roll it forward. We're going to stand for delivery. Thank you very, very much. And that's really what this is about. I mean, silver is in every single way, whether you're talking about skyrocketing lease rates By the way, the platinum lease rate is as high as almost 18%, and that's unheard of. So you have the lease rates high, you have the exchange for physical moving significantly higher, which is another sign of dislocations and demand for physical delivery. I don't know that you could ask for a more bullish setup. And then you look at the amount of silver that's being delivered into COMEX. The May and June contracts are off the hook. The May contract was the biggest delivery, the second biggest delivery ever in the history of the COMEX market. Who is standing for $1 billion in delivery?
What's happening in the silver market right now is nothing short of historic. According to Andy Schectman, and supported by analysts like Daniel Gali of TD Securities, we are witnessing the lowest level of freely available silver float on the London Bullion Market Association, LBMA, since records began, reportedly just 155 million ounces. To put that into perspective, that's less than the average daily spot trading volume in London. In other words, one day's worth of paper trades could wipe out the world's available deliverable silver. This isn't just a supply crunch. This is an existential threat to the global pricing mechanism. For years, markets like COMEX and LBMA maintained the illusion of silver liquidity through futures contracts, paper promises to deliver metal. But now, traders are rushing to secure physical bars, not contracts. The exchange for physical, EFP, a backdoor settlement mechanism used to convert paper to physical without triggering delivery on COMEX, has surged by 250% in just a matter of days. That signals desperation. A scramble to avoid being caught in a short squeeze. This squeeze isn't theoretical. In September, the LBMA saw its largest net short commercial position on silver ever, just as silver's price rose over 33% year-to-date, outpacing even gold. The premium to borrow physical silver is now climbing as high as 18%, and delays in fulfillment, even for established jewelers and fabricators, are stretching beyond a week, despite the official T+1 settlement terms. What's driving this breakdown? According to Schectman, it may be part of a broader reshoring effort, potentially initiated under President Trump, who, like many global leaders, likely realized that if strategic metals like silver aren't repatriated, national security and industrial sovereignty are at risk. Today, it's not just the US. Governments around the world are stockpiling precious metals, draining global exchanges, and leaving retail investors with crumbs. And the consequences? They're profound. The widening gap between paper silver and physical silver, the explosion in EFP volume, the delivery stress on COMEX, and the historically low float on the LBMA all point to one conclusion. The paper-silver market is unraveling. This is no longer a conspiracy theory. It's an observable, verifiable market fracture. Andy Schectman isn't alone in sounding the alarm. Keith Neumeyer, CEO of First Majestic Silver, has long argued that $38 is a key breakout threshold. We're there. And yet the market structure remains unstable. Michael Oliver, the technical analyst behind Momentum Structural Analysis, predicted months ago that silver would surge in violent, vertical fashion once it crossed critical resistance levels. That's what we're beginning to see. But why has silver been so suppressed in the first place? For years, silver was manipulated as a strategic cap, a signal metal that, if it broke free, would expose inflation, currency devaluation, and the fragility of fiat. JP Morgan, Deutsche Bank, and others have all been fined for spoofing and manipulating silver futures. The result? Artificially low prices, false confidence in paper markets, and generational theft of value from savers and investors. But now the manipulation machine is starting to sputter. The disconnect between futures and physical, the collapse in available supply, and the rising cost to borrow silver, all of it points to a system that is failing to maintain the illusion. Silver, like uranium before its run, is transitioning from a sleepy, ignored commodity to a strategic choke point, one that cannot be printed, cannot be replicated, and cannot be ignored. And here's the final truth. We are still in the early innings. Less than 0.5% of Americans own any precious metals. Most are still sitting in dollar-denominated assets that are being quietly eroded by inflation and systemic risk. Meanwhile, central banks, sovereign entities, and high-net-worth insiders are draining vaults in real time. This is the Great Rotation, not into stocks, but into real money. So what should you do? Start paying attention. Educate yourself. Take physical possession. Understand that this isn't just about investment returns. This is about sovereignty, resilience, and protecting your wealth from a system that's beginning to fail. If you found value in this breakdown, hit that like button, subscribe, and share this video with someone still clinging to paper illusions. The cracks in the silver market aren't just visible, they're widening. And when the flood comes, you don't want to be caught downstream. Stay alert, stay informed, and as always, stay sovereign. Thanks for watching.